Hello, this is Don Riggs of Business Process Improvement. This is a recreation of a presentation I did for Focus 2018 in Indianapolis, and it's regarding taking the mystery out of inventory transactions. And one of the things that I've noticed over time is that inventory transactions can be very valuable, and it's important to understand these transactions so that we can really identify what the value is. There's a huge amount of information you can get from these transactions. My name is Don Riggs. I'm with Business Process Improvement, and I've been in the industry for quite a long time. I've been involved with AXUG for a number of years. In fact, you can see since 2015. This slide isn't updated. I have received the Granite Award twice, once in 2016, and now again I received it in 2018. And really, in fact, I was awarded then, and I've been selected as Microsoft MVP for 2017 and 2018. Um, so here's the agenda. We want to kind of identify what the types and the purchases and the purposes of these inventory transactions are. An inventory transaction occurs anytime I do anything that affects inventory. They're really fascinating because they combine, they split, they combine, and it's really representative of the status of that complete set of inventory at any given time. So we're going to talk about what's in these transactions. What are they? Not only what are they, but what's in them. What are the important things you need to know about the transaction to identify where there's a problem? How do I use them to identify inventory problems? I'm going to suggest to you that for me, the first thing I do when somebody complains about inventory transactions, or not inventory transaction, but inventory, I go to the transactions to see what is actually going on. So somebody says, look, we got this, inventory's off $20,000. We can effectively try to recreate where that might have occurred, and there's different ways to do that. What's the impact on ledger and costing doing this? Then finally, what are the best practices regarding inventory? And I've been doing this a long time, and I've been called out many times to help people with inventory related problems, either from the costing side or the inventory transactional side. So I've got a lot of experience with doing that, and I want to share that with you. Types and purposes of inventory transactions. Well, there's two major types. You've got the status, which is no ledger impact. So status is things like ordered. It's telling you what the status of that inventory is in that group of inventory. So it also then splits. So you could have 5 on order, 5 reserved, or something like that. And then you've got transactional, which does have a ledger impact. So those are the ones that cause a ledger posting. And it's important to know that the majority of the transactions do not have a ledger posting associated with them. And then we talk about it's facilitating the process. So we talked about splits and combine. Now let me illustrate. When you have a sales order, and let's say you put a sales order out there for 10, and let's say that you've picked 5. Well, now it would show on order 5 and picked 5. So it would take and split that. Now, if you pick the other 5 for some reason, it would then show you that all 10 were picked. So it actually expands the number of transactions based on the different statuses, and at the end of the day should combine them once everything has been transacted against that. Or in the case of if you cancel the back order quantities, it then would still have a complete set of transactions. It's just your on order transaction that you weren't going to process. So the ones that end up in financial transactions are purchased and sold. Purchase simply means it's coming in. Sold simply means it's going out. Also, the transactions allow for adjustments. And really what the adjustments are to accommodate the timing difference between these processes. And to illustrate that, if I have a purchase order that comes in for $10 a unit, I now have a sales order that I sell an invoice, and the cost of goods then will be $10 a unit. If subsequently the vendor invoice comes in, and rather than $10 a unit, it is $11 a unit, that $1 per unit has to go someplace to adjust that cost of goods sold on that sales order. It comes in the way of adjustments, and we're going to show you that. And then the other type of thing is it identifies whether something's financially closed. And is financially closed when the purchased and the purchased and the actual sold, or the sold transactions, are in balance. So it's, think about the incoming transaction, the outgoing transactions. They're both in balance. So it says I purchased 10, I got the vendor invoice for the 10, and I sold those 10, and I invoiced for the 10. When that all happens, with also the regards of a possibility of adjustment, that now becomes financially closed. So here's the characteristics of the transactions. We have two types. We talked about the status and the transactional. So let's go and explain each one of these. Ordered is something you see on a purchase order. So if it's ordered, it means that it's a purchase order ordered, whereas on order means that it's a transaction for a sales order. Reserved physical is the commitment of inventory, typically at the warehouse level, that's saying we're committing this inventory to this order. And this is the physical inventory. Now the reserved ordered is ordering against an order, an incoming order. Let me illustrate. I've got a sales order. I don't have inventory to process it, but I can reserve that inventory against an incoming purchase order. Sounds good on the surface. It's not, because it really actually creates a situation where the closest need is already reserved on something that's coming to order, and it really causes a problem in the warehouse. So you really need to think about whether you need something reserved ordered. I'm going to talk about something here shortly that I think is a better way to handle that, but I like to turn the reserved orders off, and there's a configuration switch for it. Picked is the process of identifying that I've gone out and picked materials from a specific location and delivered them to a point of where they're going to be processed. So an example of a sales order, as I go out and pick in the warehouse, I deliver that to an area where I'm going to do the shipping transaction, or what's called the packing transaction. Again, it doesn't create an inventory transaction. Quotation receipt means that I physically received a quotation back as approved. Blocked means it's tied up in the quality order process, so it's blocked during the time it's in that quality order. And then marked is really a better process, and let me explain what marked means. Mark is something that we should use situationally that ties a demand, or something like a sales order, to a supply that's a purchase order. Mark means I purposely went in and marked those two together because I don't want somebody else to take it. Whereas physical reserved ordered is something that's much harder to control. Whereas market implicitly says this purchase order, or this part of this purchase order, is going to go to this sales order. So marking is a better way of using that reservation logic, because then that means I've implicitly said I want it to go to this particular demand. Then transactionally, we have the purchased, sold, and then also registered becomes in the transactional side, because registered means I've received it, but I haven't put it away yet. Now, one of the things you'll notice on this, on the picked, blocked, marked, and registered, These are problematic transactions that I have identified over time as causing a problem if you cycle count the inventory behind them. And let me illustrate. If I have something as picked and I take the inventory that it's picked against, because it really, in the way of picked, means it's saying that's on that transaction. It doesn't really disappear from that location until I actually ship it, unless I'm physically moving it through the WMS system, because then it does. It takes it out of the picked and puts it in another location, but it's still not out of inventory yet. If I take now and cycle count the inventory that's underneath that picked or marked or registered process, it now creates a profile in my inventory that says I have a value with no inventory quantity. So in the case of picked, it would say I have a value of inventory, let's say, that's $1,000, but I have no associated inventory quantities with it. So if you've ever seen where you look at some of your valuation reports and you'll say have a $10,000 value but no quantities, these transactions is typically what's causing it. So that's why you want to clean up these old transactions as best as you can. So here's an example of these status transactions. So here's like your reserve physical, and that's reserving against an existing inventory. Here's your order transactions. Here's your quotation receipt. Here's registration that says these have come in against these purchase orders. Here's your picked one, and there's a reserved order. So you can see the different transactions, and that's kind of what they look like within the system. Then we look at these transactions with ledger impact. Here's where you've got the purchase and sold. And really, when we look here, it's not always generally purchase and sold against a sales order and purchase order will create ledger transactions, you can see here. And we'll explain these a little more in detail. As far as the work transactions, they don't necessarily have an inventory impact. So it's not always purchase and sold. It depends on the type of transaction too, just not that they're purchased and sold. All this means it moved in and out of somewhere is all that really means. So ledger postings. Here's a ledger posting against a vendor, okay, a purchase order. So you can see here's the posting of the vendor invoice. Here's your raw material receipts. And just so you know what you're looking at, I want to explain what you're looking at is that this ledger posting here is your financial posting that occurs when you process the vendor invoice. So you'll see some reversing out, like you'll notice on this raw material receipts, you can see it reversing itself out between the two. And all we're really illustrating here is here's your conversion between the Canadian dollars to US dollars, but also you'll notice that you'll go from a posting of 120,000 to a posting of 146,000. That's because it has to reverse out the original transaction. And I know that's kind of confusing, but for the most part, what we're seeing here is here's your accounts payable, $150,000. There's your what actually ended up hitting inventory, and overall, it's showing you the complete process of the postings of that financial posting on the purchase order receipt. In other places, we go into that in a great detail. So what we wanted to illustrate here too is here's a purchase transaction. So we put a purchase order out here and ordered, so I've got 10,000 pieces. Now what I have is I've got now received 5,000 pieces. So this is an indication of the split is. I've got still 5,000 pieces on order, but now I have another transaction for 5,000 pieces that has been received. So it started out 10,000 under one. It split them out into two transactions. So let's go through the sales cycles now. And I've got to go through I want to go through a number of different cycles on some of the main processes we use in here. So, and now that ties a lot to the inventory transactions you see. So you'll see that in the sales order cycle, you start out with ordered. Well, that when I create a line, an order line in the sales order, it creates a line transaction representative of the number I'm ordering at that line. So in the situation where the customer's ordering 10, I would create a transaction out there called ordered for 10, or in this case, unordered, on order. Then the next step is reserved or marked. We kind of talked about them, but these mean that I've ran a process to do a reservation or a marking, committing that inventory to that order. Now, it doesn't mean it can't be taken for another order. You have to do something, though, to remove that reservation to make it available, is what the key is. And the more deeper you tie it, the harder it is. So marked means something you're planning on absolutely doing, but it doesn't mean you can't unmark it and make it available for other orders. Picked is the process where we're physically picking it from someplace in the warehouse and bringing it to a point where they can in turn then do the deliver process, which effectively, it's called packing. It effectively then relieves the inventory. When it's picked, unless it's the WMS system, it stays in the location it's picked at. In the WMS system, when you pick it, it picks it and then it puts it someplace, which could be a common delivery area. Delivered means it's left the building. So therefore, that also equates to the physical inventory transaction. Then lastly, you do the invoicing, and that's typically what you invoice against what you've delivered, and that's the financial transaction associated. So that cycle then is complete. So here's the purchase cycle. You've got the ordered, same thing. Registered. Registered says we have acknowledged the receipt at the warehouse. You don't need to do a registered transaction, but typically, if there's a difference in time when you realize it's here and you put it away, you register it and then you receive it as part of the put away process. Receiving means when it's received, it should be in the location that you put it in. Registered goes to a dock or something like that that says it's here. And that's where the differences are there. So register is not required, but it is a transaction that's acknowledged. Received also is the physical transaction. Then once we get the vendor invoice says that creates a financial transaction because it would allow you to have a difference between the physical, which means you want to have a cost that says this is what we think the cost is going to be based on the purchase order, to the invoice cost, which is the actual cost we paid the vendor. So there can be a difference between there. And that's what these two are to accommodate. And then, of course, you've got the return, the possibility of a return on a purchase order also. Production cycle. What's interesting about the production cycle is that you've got two sides to this. You've got the side that actually is going to be the materials you're going to use or consume in the process of production. Then there's going to be the material that you're actually building that's coming out of the production cycle. And so you have both of those cycles in here. So we'll start out with ordered. Ordered is, again, just what you saw before. It's showing that this is on order. And that means at you can have an ordered at the finished good or the part coming out of the production order, but you also have ordered on what is on the bill of materials that is needed to complete this process. So you have both in this. Again, you can reserve it. You can reserve those items I've got to bring to the production order that are consumed. I still have the same process. I can reserve it or mark it. Then I also can have a pick process, just like we had before. A pick means it has not been consumed in the production order at this point. It's just been delivered to the point of use. Issued means that I've actually issued to the production order, it ceases to exist then in inventory. It's now in that production order. RAF is the process, report is finished, is the process that allows you to say I've completed this many of these items off of this production order. So if I'm doing 10,000 items, I don't want to wait till all 10,000 is done. I want to be able to receive maybe 10 at a time or 100 at a time or something like that off the end of that production order, which in turn can go to be sold or be consumed in other downstream processes. RAF is again the physical inventory transaction. It says this is what I think it's going to cost, and it's either comes out of the system as standard or at what's called an estimated cost, which is based on the current bill of material and routing. The assumption is that's what it's going to cost. When we look at ended, that's going to be based on the actual cost, which is going to mean in a standard cost system, it's the quantity times the standard cost, and then there's a variance above or below it. So in the case of $100 is what my standard cost, but it cost me $110 to build it. You'd have $100 in standard cost and $10 in unfavorable variance. In the case of an actual costing system, it would come out and say that that product cost 110. It would have originally said it was going to cost 100 when I received it, but then again, it would have to do an adjustment after the fact. Then lastly, you have the return process. Okay, transfer order. What a transfer order is between physical locations across multiple warehouses. So I'm shipping it from one warehouse to another, not within the same warehouse. So you still have the ordered part, and that is ordered to be shipped. I've got the reservation and pick just like before. Then I actually ship it. That removes it from your inventory. It also creates the physical inventory. When at the other end I receive it, and that means I can register it. And so register means that I've acknowledged it, received it means I put it away, and also, by the way, then I've actually then completed the cycle. So I've shipped it and received it, and that ends that cycle. And then, of course, I could possibly return it. So breakdown of the inventory transactions. So what we've identified here is this is a sales order. And what you can see here is there's your item number, there's your sales order number. The lot ID is that inventory lot ID that's associated with it. So every one of these transactions has its own lot ID. That's how you identify that transaction. Now, a dimension number tells you what are the dimensions associated with that, and that would be site, warehouse, location, or some subset of that. There's a tracking ID associated with it, but I can't go into detail. But think of that as some additional information that ties to some other dimensional types of information, like where it's at. Obviously, this is saying it's sold. We sold a quantity of 5,000. This is saying now we look at here, this is where there's an update. So it's going to track the following. It's going to say, what is my physical voucher, my packing slip, and physical cost amount? Then it's going to go over here and say, is it physically posted and is financially posted? In this case, it's both. So then if I go over here, here's the financial side. Here's the financial date. There's your voucher. There's your invoice number. There's your cost and associating with the adjustment. If you remember from before, the adjustment was made in the difference between the purchase order of when we physically sold it from here and when we received the vendor invoice, when there was a difference of $26,000. And so it had to come in as adjustment. We're going to go into that in more detail. Then here's the breakdown of a purchase transaction. Go in here and you can say, here's the purchase order. It was received against social lot ID, the dimensions, the quantity, the dates, And there's your physical transaction. And here's your financial transaction. So that's where that 26,000 came from, is because there was a difference between the physical and the financial transaction. Here's your registered process. As you can see, there's no updates needed to this, but it effectively says I've registered. And this is what the purchase order I registered against. And by the way, it does create ledger transactions. It's just not the receiving transaction yet. And it does reverse amount. Here's your reserve physical. There's no ledger posting here whatsoever. And that's just saying reserve physical and what item number, because see, it's reserving and it tells you what it's reserving against work, which is part of the warehouse system. And there's your number for that work that it's doing the reservation against. Here's reserving ordered, and you'll notice here's the purchase order up here or here's the sales order up here that's reserved ordered. And so what it's saying, it's the reserved ordered is against this sales order is reserving against this inventory lot. But it does actually tell you through this lot number that it actually is reserving against here. I'm not showing you the lot number, but I'm showing you this because it's showing both of these. So here's your reserved ordered up here, but it is reserving ordered against this one. And you'd be able to see that if you combine this lot ID. Here's your picked. Quite frankly, I'll say you picked some, and this is the location and warehouse you picked it from. Here's again your individual lot ID, and you picked it for this sales order, is what you're seeing here. Okay, using transactions to identify inventory problems. All right, so let's talk about how you can use the transactions. Well, one of the things I like people to do is we can have cycle counting, and cycle counting can do us a lot of good unless we're not using it correctly. Just because you said, I found 35, doesn't mean that you should just go ahead and cycle count. You should go back in the transactions and try to determine what in fact happened. Was there something that supports that 35? Or is there something that says that 35 is actually maybe someplace else? The most typical thing I see is after let's say a physical. People that are counting are not people necessarily that know what they're counting. So you might cycle count out some, and now I go ahead and I find them. Well, if you can see a count where they counted that amount out and you find it, then you can begin to see, now I can see what happened. All I'm trying to say is you should look at the inventory to see, is there anything that either supports the inventory actually coming into the system or supports the inventory going out of the system. Because two things can happen. If you find 35 someplace, it's either it was never reported in the first place, it was counted out, or it's in the wrong location. There's no good news there. So the more you understand about what happened, the better off you are in solving the problem long term. You got to keep inventory processes up to date, and let me explain. I had an account, a GEA, a large multinational out of Europe, and they had a problem with their PO receipt process, and they were getting behind in it. Well, they were cycle counting every day, so they would physically see they had 10, let's say, and there was none showing on the system. They would count in 10. Now along comes then where they voucher or they process the vendor or the receipt process, and they do the receipt as 10. Well, rather than the invoice, they now have 20 in inventory. So what they've done is they've actually, through the counting method, by not keeping it in turn with in time with the inventory process, you can see the problem. is it actually forces your inventory out of balance, not into balance. So what's important to note is that if you think you're going to do physical transactions and not follow up in a very timely fashion with the computer transactions, you will never have an accurate inventory. Never. Because the only time that inventory is accurate to the computer is when all the transactions are posted associated with it. We talked about this a little bit, is look for old incomplete transactions. If you've got transactions that have been out there for a year, like a picking transaction been out there for a year, chances are you're not going to pick that. So you need to try to reconcile or try to figure out a way to get that out of there. Some of them are easy to fix, some of them aren't so easy to fix. So it's just a question of what they are and the best way to fix them. Like, to give you an idea, if you had one word registered, you would have to cycle count inventory in against to the location that was registered with, and then drop the reservation, and that would then drop that, and then you'd have to cycle count that quantity out. So doing it right in the first place is always not, again, it created by improper cycle counting. Okay, and you really have to understand the impact of inventory closing and recalculation. What the purpose of those two are is to primarily satisfy either, for this purpose of this, either transactions that occurred that are a difference between the timing of physical and financial. Again, you can see where I received a purchase order, I went ahead and sold that, but then the vendor invoice came in and it was a different number. I have to accommodate that difference. The other thing it does, and just I'll mention it while we're here, is it accommodates things like FIFO layers. And let me quickly illustrate. The system uses an average calculation. Now, I've called it weighted average date, but I think it's more of a running calculation, but effectively it's more like an average cost. In other words, whatever comes in, it averages over the cost of those and it establishes a new average cost. That is the transaction that it uses. So when you think of LIFO and FIFO, they're adjustments to that transaction. So it is part of the recalculation process. In fact, in FIFO systems, we run a recalculation every day, so that we're in our FIFO layers, because other than that, you're not seeing the FIFO layer. And by the way, it does come in as an adjustment. GL and costing details. So again, what we're seeing here is, again, the purchase and sold. And here's, again, going back, and you see your sales transaction. What we're showing you here is this is the sales transaction before we run where we run our adjustment process or recalculation process. So here was, I take that back. This does have the adjustment in it. Here's the associated posting. And what this is showing, the original posting, and that wasn't based on the 146,000. It was based on the 120. So that was a little bit confusing. But here's how it occurs. When I do a recalculation setup, and let me go back a couple, because the timing is a little bit. This is showing this adjustment being done. Now, what I'm trying to show you going here is, here was your original financial postings. This is before the adjustment, because it's not going to be in this. It's going to be in a settlement. But you can see it will adjust the transaction, but the posting occurs at a different point. So it posted originally the 127. It now created this adjustment. And keep in mind, the principle is not important here. It can be adjustment based on FIFO, but it's not in this case. This was based on a timing difference. So it shows you made the settlement adjustment through this process, the recalculation. And again, the result was, it was caused by the fact that this $146,000 occurred during the financial transaction. So that's a little bit of rehash, but I think I want to enforce that impact. And then this is showing you the purchase order receipt process. So it's showing It substantiates that. You originally came in 120,000, and then this was the vendor invoice. So it reversed out, and just so you know, this transaction would reverse out the physical. So it was originally posted at 120,000. It reverses that out and reposted at 146, and then that's the basis that the actual recalculation occurs. And then really what I want to talk about here is that one of the things I do want to cover with you is where do these ledger accounts come from? And I'm going to tell you generally, item group is the main thing they come from. So if you look at cost of goods sold, that's your 500150 account. And let me go back to, and there's your cost of goods sold account there. So I wanted to show you that that's where that is coming from. So again, the item group defines most of where your postings come from. And if we go back to the previous there, if you look at that, there's your raw material receipts. Okay, so now we're going to talk just a little bit about best practices. And really, an inventory best practices, again, we talked about a little bit. Keep your transactions up to date. In other words, the more you can get to the point of the transaction being the same time as the physical transaction, that'll increase your inventory, and you can rely more on your inventory. Anytime you're going to do the physical transaction separate from the computer transaction, there's all kinds of problems in interpretation you might run into. So that's one of the reasons why we do a WMS system. Then focus on inventory accuracy. You're not going to get better unless you focus on accuracy. And when we talk about accuracy, it's not just how many you have, but where it is. Because if you don't know where it is, you are going to create inaccuracies because of that. So keep that in mind. But it can't occur until you have a timely way of posting your transactions. Also focus on your inventory costing accuracy. Many companies go out of business as they grow because they do not have a good handle on what their costs are. And what typically happens is as they grow, things become more competitive. They're dealing in a bigger marketplace, and they end up taking bad jobs where they don't make money, or their margin is not there. Again, know what you're counting and why you're counting it. You cause more problems by not understanding what you're counting and counting it than not counting it at all. And again, no counting can work unless you have transactions up to date, and the transactions follow the physical transactions. Resolve the old transactions. Make sure that you're getting rid of old status transactions and open financial transactions. In other words, close production orders. If you've got an old reservation or registration, you've got to solve that. And then the last thing is to complete your inventory process every period. And let me illustrate what that means. Usually an invoice and sales order, you don't have a problem because most of the time what you ship, you go ahead and invoice probably same day or next day. But you get into the other two, like your production orders and the vendor invoices. If you take the example we had before, if you take and you waited to post the vendor invoice to the next financial period, that adjustment, which adjusts your cost of goods sold, would not occur in the same financial period as the sales occurred. So the more you can do to try to get the vendor invoice current to the period, the better off you are. So a lot of people leave their month open for a few days so they can post those vendor invoices into the current or into that period they're closing. And here's the other one that's important: ending production orders. I can't tell you how many times I say this. People will create production orders that'll span multiple periods. Well, here's the problem with that is that when you're selling, let's say coming off that production order, it's taking what the estimated cost was at the time. Now, when you actually close that production order, if there's differences, all that happened all those months before all hits in the same period. There is no reason, unless you're building one of something, to leave a production order open for more than one accounting period. And a lot of people don't like to do that, but it's the way you should really do it. So if you're building 10,000, if you're receiving one of those in a period, you should in fact try to end that production order within that period. Now, sometimes you will have an overlap, but generally that's what you want to do. End all your production orders within the period they're certainly completed. Okay, and that covers this.